Hello and welcome to this podcast. We're working through the requirements of Section 11A, and in this podcast we're going to look at the requirement that expenditure must not be of a capital nature. That's the last of the requirements, but we're also going to have a look at Section 23 and a past exam question in two following podcasts. So there is the general deduction definition, and the final criteria is that expenditure and losses are not of a capital nature. So what does that mean? Well, there are a number of cases where this has been tested by the courts, and here are some of the principles that apply. It's important to notice that these cases are different from the cases that we looked at when we looked at capital and revenue under the gross income definition. Although maybe the principles overlap, it's important to quote these cases when we're looking at expenditure. So in new state areas, the court distinguished between expenditure that adds to the income earning structure of the taxpayer and expenditure incurred in working the income earning operations of that taxpayer. So for example, buying a new machine is capital, paying for the electricity to run the machine, that is revenue in nature. In George Forest Timber, they distinguish between acquiring a source of profit and working the source of that profit. Again, quite similar to the test in new state areas. In Rand Mines, they looked at acquiring rights, and they said that acquiring a right to perform operations is capital in nature, but performing those operations and incurring costs in performing the operations is revenue in nature. And then in British Insulated and Helmsby Cables, they stated that capital expenditure creates an enduring benefit or advantage. So something that lasts and something that can be used in the business. And in BP South Africa, they looked at how long does something need to endure, and they said there's no prescribed minimum period that determines whether something's capital or not. Each case has to be tested on its merits. But we're looking for some sort of enduring benefit and some sort of addition to the income earning structure or new source of profit. So let's have a look at some examples. Are the following capital or revenue? The purchase of a new machine? Well, that's capital. The repair of an existing machine? That is capital. The payment of monthly salaries? So let's have a look at some examples. Are the following capital or revenue? The purchase of a new machine? Well, that's clearly capital. That adds to the income earning structure. The repair of an existing machine? Well, that's also capital because it adds to the income earning structure of the company as it stood before the repair, i.e. with a damaged machine. Having a repaired machine is clearly better than having a damaged machine. Now there is a specific deduction for repairs, but the whole reason there's a specific deduction is because it fails the general deductions test. The payment of monthly salaries? Well, that's incurred in performing your income earning operations. There's no addition to your income earning structure. It is a repetitive cost that leaves you with no enduring benefit at the end. The payment of a restraint of trade? Well, you've acquired a right. The employee had a right to work for whomever he or she chose to. You have now acquired that right and they have forfeited. That's capital in nature. It has an enduring benefit. Now, again, there's a specific deduction, but the reason there's a specific deduction is because the amount is capital and fails the general deduction test. And finally, the payment and settlement of a legal claim. Well, does that payment give you any enduring benefit? In all likelihood, the answer is no. The only possibility that it might give you an enduring benefit is where, as part of that settlement, you acquire a right or an asset that might have been previously in dispute. But by and large, settling a legal claim doesn't give you any enduring benefit and is probably not capital in nature. It might be capital for the person receiving the benefit or receiving the payment, but the test for whether the payment is capital as an expense is not whether the recipient has a capital receipt. It might be capital for the recipient, it may still be revenue for the payer. So those are some examples that hopefully help us to distinguish between the two. That's all we're going to have a look at in this podcast. In the next podcast, we're going to have a look at the restrictions on deductions made by Section 23. See you then.